In this episode, I try to ease your fears and overcome your hesitance of signing up for the Flex Spending account at your job. Let's get started.
Let's get some money.
From New Money, New Problems, it's the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. Negotiating compensation, purchasing your first investment property, helping your family with money, the highs and lows of entrepreneurship. New Money brings new problems that require new solutions. Join us as we work through them together. I'm Brenton Harrison, and this is the New Money, New Problems podcast.
Hello and welcome to this week's episode. This is a teaching episode that is time sensitive. This is one of the times of the year where I get into the nitty-gritty details of employee benefits because it is open enrollment season. If you're not already familiar, open enrollment is the time where employers give you a PDF or a website or a packet that has details of all of your available employee benefits, and they ask you to make your elections for the upcoming year. And as you've heard me say many times, if you're a long-term listener, the three most underutilized benefits that I see are flex spending accounts, health spending accounts, and dependent flex spending accounts. But we're not going to spend this episode on all three. We're going to focus this episode on the flex spending account because in my experience, it is the one account that I have seen people most hesitant to sign up for when they have all three options at their disposal. And there's several reasons for that. When it comes to health savings accounts, there is a lot of hesitance in the fact that with the health savings account, you have to pair it with a high deductible health plan. And many people don't like or are afraid of the concept of a high deductible health plan. So we will get some questions about that. But if they understand and are comfortable with that plan, the actual health savings account element of it can be really attractive. You can put money aside that's pre-tax. If you don't use the money, it continues to grow in the market, can be used for eligible health expenses or after the age of 65 for whatever you want to. So there's a lot of attractive elements where once someone has keyed in on the concept, you don't have to do a lot of back and forth convincing them to do it. With a dependent flex spending account, it's the same. If you have an eligible child for a dependent flex spending account, there are some really expensive things that parents pay for young children, namely daycare expenses or summer camps that are eligible for dependent FSA use. And as a result, you just don't have to do a lot of pulling and tugging when you're trying to convince someone to sign up. But an FSA is something that I always have to encourage people to sign up for various reasons. It may be that they think that it's a use it or lose it plan, where if they don't use the money, all of it is going to revert back to the employer. It may be because of the accurate fact that when you choose an FSA contribution for the upcoming year, unless you've had a major life circumstance that makes you eligible to have that amount changed, you actually have to stick with that payroll deduction for the entire year. So some people will say, I don't want to overestimate what I can spend in that FSA, be wrong, and then all of a sudden I can't change it, and it's just coming out of my check every 2 weeks or every month. Very, very valid reason to be afraid of it. But the biggest reason that I see people hesitant about an FSA in my experience is complication. They don't understand how it works. They don't understand how they're going to be reimbursed. They don't understand for what it can be used. And as is the case with most complicated things in our life, when we already have a complex life, if we can't avoid it, we choose to do so. So I'm hoping that in this episode, I can give you a plan of action to utilize your FSA in a seamless way. And we're actually going to start with understanding what you can actually use an FSA for in the first place. Because if you can find a way to integrate FSA use into your life, it is an easy tax deduction that you can use to your benefit. In 2025, you can put up to $3,300 aside pre-tax to pay for FSA eligible expenses. And if you're a high income earner in a higher tax bracket, that can lead to some significant savings for things that you were already going to pay for. For example, if you're in the 24% marginal tax bracket and you were to max out your FSA contribution at $3,300, for things that you were already planning to pay for, you would save $792 in taxes. That's not an insignificant amount of money when you factor in the fact that these are things that are needed to manage your health. So let's get into some tips for how to make this process more seamless, starting with familiarizing yourself with eligible FSA expenses. The first step in figuring out whether whether you should or can contribute to an FSA and how you would use it is simply figuring out what you can use it for. So we're going to put a link in the show notes to eligible FSA expenses. And there's a lot of over-the-counter items that you're going to find when we go further into this episode. But for now, I want to talk about actual health expenses for your care. And you can see if you're looking on screen, categories of FSA eligible expenses: health insurance copays, costs for office visits, coinsurance payments, and deductibles are all eligible expenses for FSAs. Dental work, vision expenses, eyeglasses, and prescription contact lenses, prescriptions, therapy and counseling services, although marriage and family counseling does not apply, chiropractic care and acupuncture, hospital fees, surgery and diagnostic services, allergy testing. If you're looking through this list, it's basically saying that almost anything you can think of that's an out-of-pocket health expense is potentially eligible for an FSA. So what I would encourage you to do once you look at these eligible expenses is to look over or think of the past years for you and your family's health and try to plot out a plan for what you know you could potentially use an FSA for. For example, I know that there's going to be a small copay that I pay every single year if I'm going to go see my primary care physician. The same is true for my wife, for my son. My son also has allergies and asthma, so there's out-of-pocket costs that we pay for his medication, where it's mostly covered by insurance, but it might cost us $15 or $20 for an inhaler. It also might cost us out of pocket to take a specialist visit, like to go see an allergist when it comes to his year-to-year health expenses. I also am someone who wears glasses, so I know that every single year or every other year, I'm going to not only have to pay for an eye exam, I also may have to pay to update the prescriptions in the frames that I already have, which is an added expense. And if I can have an idea for what that estimate looks like, I have at least established a baseline of costs that I'm already going to have to pay for that I could save taxes on by putting that money pre-tax into an FSA first. The next step beyond your care expenses is to plot out your regular purchases that may be eligible for FSA use. We've talked about this in past episodes of the podcast, where the easiest way that I've found to make over-the-counter purchases that are eligible for an FSA is to dig around a large retailer's FSA store. So we've talked about it based on your retailer of preference. You may be an Amazon person, you may be a Walmart person, you may be a person who has decided against being a Target person, but whatever your fancy, all of those larger retailers are going to have sections of their website that are FSA and HSA eligible items. So for example, if you're looking on screen, we're looking at Amazon's FSA store. You can see categories such as over-the-counter medication, children's cold and allergy medicine, digestive health, seasonal allergies, and you can go through all portions of this website and you can plot out, okay, I can get Tylenol, I can get Advil cold and sinus, I can get Motrin, you can get your vitamins, you can get your feminine things, right? So there's a whole lot of stuff on this site that you'd be surprised that you can buy, that you have to buy every month or every other month, that you can just go ahead and get with your FSA. So if you familiarize yourself with those things, it will trigger you to, hey, instead of buying this stuff and going to the store and paying more for it, I can just go straight to Amazon and purchase it from there. The next step is to dig into the rules of how your employer treats your FSA. And there are several areas where this is important. The first has to do with how you're reimbursed. Again, going back to the complication of FSAs, the biggest hindrance that I've seen is people don't understand how they get their money out of the plan, and this can vary based on your employer. I would say the most complicated way, which can still be managed well, is to pay for it out of your own pocket and then to ask to be reimbursed by the plan. This would involve keeping track of expenses in the same way that you would if you were on a work trip and bought a meal. However, it doesn't necessarily have to be at the time of purchase. I see several people who will save their receipts, put it in a folder, and submit all of it for reimbursement at the end of the calendar year. Whatever works for you, if you're in the reimbursement model, you can again find your system that makes it more easy once you understand how those expenses are paid back to you out of what's in your FSA. Another form that's becoming more popular, especially for larger employers, is an FSA card. And this is comparable to a debit card. If you have a debit card, and you have $100 in your account, then you know that you have $100 that you can spend. The same is true with an FSA debit card, where if you've loaded $200 on that card, you can go and you can add that as a payment method on sites like an Amazon or a Walmart. And you can also swipe or insert that card to pay for things like a copay or an out-of-pocket expense that you might incur at a place like a physician's office or a dentist's office. The next portion of the plan rules that you want to dig into is when the plan year expires. Now, for most employers, that's going to be December 31st, but you'll also find that many will offer an extended period or an allowance as well. So, for example, the most common one that you'll see is typically March 15th. So you'll have an employer that will say all of your FSA eligible expenses have to be submitted for reimbursement by December 31st, but there is an extended period until March 15th that will keep you from having those funds revert to the plan if you didn't meet the original deadline. Now, your employer may or may not offer this extended period, so you want to make sure so that you're not assuming that you have until March 15th when December 31st is truly D-Day for your plan. But the good news is, even if that's the case, an FSA is not a pure use it or lose it plan. We shared in the intro that that's what many people think, but with an FSA, you actually have an allowance period that you can roll over from one plan year to the next. It is not like an HSA where you can roll over the entirety of what's in your plan, but in 2025, you can roll over $660 from one FSA plan year into the following plan year. So when you're considering how much to put aside in an FSA, you don't have to find an amount that you can spend down to zero. You have to choose a conservative number that will allow you to spend what you can spend and come within that $660 threshold. For example, if you've calculated that you can conservatively spend $2,000 from your FSA, you don't have to set your contribution at $2,000. You can set it at $2,660 because if you spend that amount, you'll still be within the threshold and you can carry over that money to the next plan year. If you're planning to max it out at $3,300, be aware that with that $660 allowance, you would need to spend $2,640 towards your health expenses to come within that threshold in the current calendar year. So all of this information gives you the knowledge and the platform to choose a contribution amount that you're going to have deducted from your paycheck every payroll period. And I do agree that it's somewhat important to choose a number that you know you can hit in terms of coming within that threshold, because you don't want to have the experience, which I have seen people have, of getting to the end of the plan year or the allowance period and all of a sudden it's March 13th and you're scrambling trying to find $1,500 worth of things that you could buy at your local Walgreens or Duane Reade. But if you have a plan of action in place, this is something that you can put in motion in a way that will not just benefit your taxes, it will benefit your month-to-month cash flow and allow you to have these products that you already paid for in your house at a lesser expense. I know this isn't the sexiest of episodes, but as you've heard me say, there are riches in the niches, and there are certain employee benefits where when you utilize them effectively, it can lead up to larger returns when you look at your entire portfolio. We'll be discussing more employee benefits in October and November as this is open enrollment period for most employers, and I hope to see you right back here next week.
Let's get some money.
From New Money, New Problems, this was the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen.